it's been an exciting start to the year already, and so we'll have a little look at what the rest of the year may hold for us in terms of threats or opportunities. As always, I'm just going to begin with a quick risk disclaimer that you can read yourselves there. As always, none of the suggestions or conversation we talk about should count as specific trading advice. We're all adults, and you can all make your own decisions. And if you have any challenges or concerns, you should consult an independent financial advisor. So what am I going to talk about for the next hour or so? Well, we're going to talk about, what is the crisis that is occurring, and what's actually happened and come through for us to present us with such an opportunity to talk to yourself. And I'll talk about a few of the big major FX pairs, and also a few ideas of trading strategies during this sort of, let's say, impending volatility that we may see range of 2016. As always, it's very important to consider risk and to be managing risk, and so effectively we'll be talking about what one can do to help manage risk during a crisis period. And I'm also going to be sharing with you a couple of ideas on how you can measure volatility, and one in particular that may help give you a little bit of a heads up that impending volatility is coming your way. And then at the end, I'll talk about the conclusions and some of the takeaway points that you can have, and I'll happily take any Q&A at the end. If you do have questions as we go through, then please just pop up, and I'll try my best to answer it if I see it, and if not, just remind me at the end, and I'll happily take any questions. As my colleagues, the webinar is being recorded and it will be available after the session, so you'll have a chance to view this to your heart's content time and time again, and also see it as the historical document when a year from now we're talking about 2016 being the biggest year of crisis for 6-7 years or so. So what actually happened was, we talk about, a year of crisis being 2016, but the question has to be asked, well, where did this all come from? Where is this started? And when I actually sat down to look at what we've experienced just in the last year, and in particular during the whole of 2015, well, when you look back, 2015 was an amazingly volatile year in its own self. We had probably what was the biggest major event was the removal of the franc peg by the Swiss National Bank, which for some people that was the biggest event they'd seen in 20 or 30 years of FX markets. We had the eventuality of the ECB QE, the dollar holler, I call it, in terms of we had a real rush towards dollar strength, and that had a knock-on effect on the BRICS and emerging markets and the pain they felt. We had terrible woes with Russia, and if you watched the dollar ruble, that was a great trading opportunity. And during, as the year went on, we had increasing wobbles in China, and that sort of really came to a head at the end of August, and that had a knock-on effect, into just even the major indices. I think the kind of the Monday after the sort of Chinese event, I think the Dow dropped something like 900 points in a day and such. So it was, there was plenty of volatility there, and that all had an impact on commodity prices. And then itself, that was a knock-on effect into what some people call the COMDOL, so the commodity currencies, the Canadian dollar, Aussie dollar, Kiwi dollar. We've had just languishing FTSE woes, which we'll talk about a little bit more later on. And then at the end of the year, Janet Yellen, finally did what she'd been telling us she was going to do for 18 months. And then, she actually went around about and raised rates. And so I suppose when you look back on it, as I say, 2015 was quite some year in terms of volatility. And the question you have to ask yourself as a trader is whether you see that, was that a threat or was it an opportunity? Some people would look at that and, there'd be a good deal of sucking of teeth and sort of wishing to avoid such volatility within markets. Other people will look at that and say, well, they all provided fantastic opportunities for the savvy, educated trader. And it's a question of, well, what could we learn from that we could use going forward into 2016? Because, we're into 2016. What is it? We're about 5, 6 weeks into 2016, but we've already had quite an eventful sort of, let's say, 4 to 5 trading weeks. I'm sure you've all seen it yourself. There's been some amazing moves. We've had those continued China woes. Okay, it's not going away. Okay, and one day we see great news, other days we see terrible news coming out of China and terrible events in terms of the particular stock market. And invariably, that has just made a lot of the major indices flip flop. And it's one of the kind of, let's say, the threads that we'll discuss throughout the whole event is that we're increasingly moving towards almost like a global index because that they are so correlated these days. I suppose the biggest surprise we had was the Japanese announcing negative interest rates, which is going to be one of our first topics. And the kind of knock-on effect on that is what we have seen is euro and Japanese strength, which might come as a surprise to people who over the last, let's say, 2-3 years have seen basically euro and Japanese weakness has been let's say the easy bet. We've had continued sort of oil drops. Okay, we've had pushing down beneath 30, but we've had a little bounce in the last week or two. But I wouldn't be getting too excited about that. We've seen a slide in the US dollar, and I think this week alone it's finished its kind of its biggest drop since about 2009. We've had the pound crushed. Okay, we'll look at that in particular, and once again we come back to that question of have these been threats or have they been an opportunity? I personally, the way I view it is that the market is always full of opportunity. To think of it is that in the market is always opportunity, and that what I need to do is I need to sit and be prepared and be savvy about how I can actually engage with the market and make sure that I operate in the most effective and profitable manner, regardless of what's actually going on around me. So what I'm going to do is I'm going to dig into a few of those ideas. Okay, and we'll talk about a few of those those big FX pairs, and in particular probably the kind of the major one that I have seen has been Japan. Okay, and in particular the Japanese yen. What we've seen was that towards the end of last year, Abenomics 2.0 was effectively unleashed, or at least certainly given the sign off by the Japanese political party. And in particular, what we saw was that we saw the governor of the Bank of Japan, Kuroda, last Friday, the 29th, he made a sort of surprise move of setting negative interest rates for Japan. And I suppose the kind of interesting thing to take away from that is what it's proved is that the central bank governors are prepared to do whatever it takes to avoid deflation and to generate inflation. And that's probably the interesting takeaway point. Okay, they there's literally there's whilst the tools they may have to hand are running out of let's say running out of efficiency, that they are prepared to do whatever it takes to effectively to avoid that. And this was one of those incidents. But the interesting thing I see as a trader is, well, what was the impact on the Japanese yen? That's the kind of thing that interests me and actually tells me a whole lot more about the story. So if we look there, this is a chart of the Japanese dollar yen. Okay, it's a daily chart, and invariably you'll see across all of my charts, I do a lot of my work off the weekly and the daily charts. Very, very simple chart setup here. Okay, very simple in terms of the green is a 200 period moving average, the red is a 50 period moving average, and the blue is a 20 period moving. Just very, very simple with a bit of price action and some horizontal lines of support and resistance. Nice and simple. That's the way I like to work. But the interesting thing was that the announcement was made last Friday, and as you can probably see from the pen or pointer, or as you may have actually even seen yourself if you were trading it, that the yen weakened drastically that day. There were some huge moves, okay? And for those of you who are completely new to trading, by the understanding of the dollar yen, when that dollar yen moves up, that means the dollar strengthening and the yen is weakening. But invariably, look what actually happened. He set this kind of interest rate, the news about the negative interest rates, the yen weakens, he gets what he looks for, but within a week, ladies and gentlemen, within a week, that move is reversed, and the dollar yen is back in a downtrend. The dollar yen is back trading where it was a week or so before. And that, for me, that is telling me a huge amount about the story. What we're seeing there is just a renewed yen strength, and that tells me an awful lot about what's particularly going on. They've completely reversed those moves from the Friday 29th, and what that tells me is that the market has no confidence in his ability to shape the market. That's what it's telling me. And the second picture is, and the second big point, which we'll look at another chart, is that he wants a weak Japanese yen. To be truthful, all of the central bank governors want weak currencies because of the, let's say, the conventional wisdom about a weak currency helping to sort of drive exports and growth and therefore inflation. So they're all in a battle to sort of try and weaken currencies, but he's not been able to do that. And invariably, what we've seen is increasing yen strength. Now, what we've also know is we've seen over over the years is that the Japanese yen is still seen as one of the safe havens of the world. And if there's money moving into the Japanese yen, that in itself is telling me another story about that, people are putting money in their safe haven because they foresee some sort of crisis coming. So it's just another little element, another element of nuance, another way that the story is being played out, and how the charts are giving us just a little hint and an indication of what may be down the road for us. And to sort of just back that up, let's have a quick look at some of the other sort of, let's say, the bigger Japanese charts in terms of the big picture on the dollar yen and also on the Nikkei. If we look at the Nikkei here, once again, daily, the Nikkei did exactly the same as the dollar yen. Okay, when the news was announced, basically people thought, well, nobody's going to keep their money in the bank. What they're going to do is they're going to buy shares, and then effectively the Nikkei had a great day and rallied strongly towards the end of that week. But what we've actually seen was that once again, within a week, price has fallen away again and is back down on its on the lows of where it's been trading for 2016. That once again, as I said, is just telling me that people just don't have confidence in what they're actually seeing and hearing. On the terms of a bigger picture, what we can see here, this is the dollar yen against the weekly chart. Those of you who know me know I love the weekly chart. A lot of my work is done off that. When I look at the dollar yen on a weekly basis, what I'm seeing there is a really rather large head and shoulders pattern that has been sort of brewing over the last year, shall we say. And what I see with that, and if you know about your standard technical analysis, is that with a head and shoulders pattern, we look for a significant neckline. And what I'm seeing is a yen 116 as the significant break. Well, then what we'd be looking, just using very simple standard TA, is that we'd be looking for a move down to the sort of yen 107 area. Now, just remember what I said earlier is that what that yen is strengthening. If that plays out, that is yen strengthening, dollar slightly weakening as well. And that's just another thing when everyone's looking for a safe haven, that's invariably where that money's piling in. So just keep an eye on that. It's one to watch how it plays out over the next few weeks and months, and in fact throughout the rest of 2016. So having spoken about the yen there, let's have a little chat about the euro and the eurozone. So, invariably 2015 was the year that we saw the ECB QE program. They were rather, Super Mario there was right to the party, and invariably, as you've seen that it didn't have the kind of impact that he was hoping it would have. He invariably has, let's say, he has flattered to deceive in the last few of his monthly announcements when he's talked about, well, he will do whatever it is required to once again to effectively just, create inflation rather than deflation within the euro. As a general sort of conventional wisdom, QE has been, good for your, let's say, your zone's stock market, but poor for your currency, and that is what he's actually hoping. And he's sort of said words to that effect that he will increase the QE program if it's required. But if we look at the sort of the big picture of the let's say some of the major euro currencies and indexes, well, we'll see that whatever Super Mario is saying isn't actually being played out in the market itself. So this is the euro dollar on the weekly chart. we saw, fantastic, from about May 2014, it was just one-way traffic down there right into the start of 2015. Just easy money to be made, selling euro against the dollar because of hint of QE happening. And then actually, when it did happen, sort of, January, February, March, and we start to see, well, invariably, what actually happened was that euro dollar just effectively traded realistically in a range between about 104 and 114 for the rest of 2015. One of the things that I'd like you to sort of to look on is that, and it's something I've talked about in my own presentations and blogs, is that on the 3rd of December of last year, that the weekly chart on the euro dollar and on a few other charts we're going to look at, we finished with a bit of a bullish engulfing candle. And at the moment, that to me is giving me maybe a little bit of a hint that it's the end of euro dollar weakness for the near future at least. And what backs that up is that actually this week just completed. Yesterday's weekly close was the first strong close on, let's say, the sort of the north side of the 50-period moving average in over 18 months. If you just look back at your charts, it's not until about June of 2014 that the euro dollar has closed on the other side of the weekly 50-period moving average with any kind of significant. And so that's just another final little hint that's telling me that he might want to sort of devalue the euro, but the market's not buying it. The market's not buying it at all. And what we're seeing is, having had immense dollar strength, we're seeing there is just the hint of dollar weakening and euro strengthening. Now, in terms of the euro dollar, I'd probably still need to see it up above kind of 114, 115, holding to really to sort of settle that story. But definitely, it's giving us hints there that the market might like to move in that particular manner. And if we move on to looking at the euro sterling, one of my own particular favorites here, once again, just a weekly chart. For the last couple of years, just selling euro sterling was a great trade. I should know. I was a heavily short euro sterling for the last couple of years. But then, last year, what happened? Effectively, the 70-cent level became a line in the sand. And I talked about towards the end of last year that we were starting to see what we call an inverse head and shoulders, okay, on the euro sterling. Now, the rumors always were that, basically once price got beneath 70, then the Swiss National Bank was stepping euros, selling Swiss, for their own agenda. That might be true, it may not be true. All that I can do is trade what I see. And what I saw there was an inverse head and shoulder, which kind of signaled the end of that sort of downtrend, right? And what we've seen since since about sort of from that right shoulder holding, what we've seen is just euro strength and pound weakness. And what we're really looking at is that head and shoulders, with just once again very simple standard technical analysis targeting in the region of about 0.80, getting us also back above that weekly 200. And if we were to hit that's a very bullish sign for euro strength. And as I said, remember, this is what he doesn't want. And then let's also have a little chat, with regards to the Eurozone. Let's have a little chat about the DAX. Now, once again, it's a weekly chart, the DAX. You might be able to pick out that the first 4 months of last year was just, there's no other word to describe it for traders. It was just gravy, okay? DAX was just going one way. And if you were buying DAX, whether you were an intraday trader, a swing trader, a position trader, it was just, it was just easy money. But the rest of 2015 was a pretty tough year. There was a few weeks and a few months that were nice, but it was actually a bit of a tough year in the DAX after that. Okay, but once again, we had a support level which I see at around about 92.50, and think about that. In less than 6 months, we went from highs of around 12,400 down to 92.50. That's quite a considerable move, and even though we had a bounce, once again, we're back down towards that level of around about 92.50. And if we start to see that break, well, then I start to see 8,900 and 83.50 as those next big particular levels. So, all of my ideas, my scenario analysis is just played out on just very, very simple technical analysis, the big weekly chart, just looking for that, waiting and letting it show me, let the market show you its hand, so to speak. And as I said, keep an eye on that 92.50 level, because I think it's going to be an interesting one to see how the DAX responds to that. So as I said, in a period when everybody is trying to debase currencies, to help the growth in exports, strength in euro and yen through 2016 will probably have an impact on those economies. Not what either Draghi or Kuroda want to see. They don't want strength in the euro and the yen. So they are going to be forced to do something to alter that, to change that. So will it be a case of more forms of QE or increasing the negative interest rates? What we're doing is they're setting up a bit of a squeeze upon themselves that will invariably manifest itself in some form of action within the market. So I said in my own particular sort of blogging that I thought the yen might be the kind of the strongest currency for 2016. I wrote that a couple of months back, and I still kind of stand by that. From what I see, I still think that we'll see yen strength unless the Kuroda does something really quite sort of wild in an effort to stop that. So if we're going to see euro in the end strength, and that's going to give Draghi and Kuroda a little bit of pain, well, who might benefit? There's always somebody who can benefit from another's pain. That's just the way financial markets work. Well, my own view is a rather smug-looking Janet Yellen there, and in particular that the US dollar may benefit from that. And how do I see that? Well, really, there's only been one story in financial markets, in particular FX markets, for the last 18 months, which was about dollar strength. As invariably as Yellen set the world up for her views that that they were going to have to start an interest rate rise. Okay, basically everybody was buying US dollar. However, that has had a knock-on effect on the basically a lot of the American manufacturing companies, and invariably there's a lot of let's say squeals for dollar for some dollar weakness. What I think might happen is that we will probably see dollar weakness through this year, and that might be enough to help their economy just sort of just tickle the soft underbelly of recession, but without actually going into recession. And that in itself will help keep that whole sort of charabanc going for another 6 to maybe 18 months. For those who don't know, charabanc is another word for a bus, basically. So they've been keeping the bus going for the last sort of 6 to 7 years, and anything to do that they may well do. So that's what I think she may actually benefit from that in terms of dollar weakness may sort of flow through into helping the US economy. But then once again, if the crisis really does deepen, then don't be surprised if we see all manner of tools being brought out of the shed to sort of try and influence those markets. So here's a quick weekly chart of the dollar index, and in particular, what I see here is we had a bit of a double top, and once again, what I'd like you to look at is that the bearish engulfing candle that happened in that same week on December 3rd, 2015, and that was effectively signifying a double top. Some might even call it a triple top. But then effectively this week has been a rather bad week for the US dollar as well, and invariably we've seen really a sort of kind of strong falls in the US dollar. So maybe that US dollar strength is coming off the top, and as I said, in a time when everybody's trying to debase their currencies, Janet Yellen might be very happy with that in terms of that might help her just keep the economy just ticking along long enough to keep her out of too much trouble. One of the other things to have a look at, just because it's priced in US dollars, is gold. What we've seen is, for the last few years, selling gold and silver have been great trades. Okay, but once again, I just want to draw your attention to that. The sort of there's a bullish engulfing candle at the end of at the end of a kind of a long downtrend. It was that same week, okay, of the 3rd of December that we've seen that, and I know I've had a few of my own option plays underneath that, and what we've actually since then is we've seen some gold strength over the last couple of months, which is in an old-fashioned world, when invariably when there was trouble in the world, people would buy gold, but that hasn't always been the smartest, or rather that hasn't always played out over the last few years, where invariably markets have just shrugged off that. But that kind of strength we've seen for the last couple of months, and with gold getting up above the 50-period moving average, might be an indication that there are some people getting a little bit nervous, and some people buying a bit of gold just to act as a hedge against any kind of trouble that might be coming down the garden path, so to speak. And once again, let's have a little look at crude oil, because it's in dollars, and that's been a great downtrend. Okay, I personally am not an oil trader, but I do keep an eye on it because of the sort of intermarket relationships of all the events. And what we saw is, that at the start of this year already we pushed below $30, okay, which hasn't happened for many a year. And but the thing is, we couldn't hold there at the moment. And I suppose the question becomes, could $30 hold as a support level for the next few months? And the question would be, well, what happens if a global crisis, really does sort of take hold on those market economies? Will that be good for oil, or will that be poor for oil? Well, my natural viewpoint would be that we'll see, we will actually see new lows, because invariably, if all of the global markets go into a recession, let's say if the crisis went terrible, well, then there would be less demand for oil, and we're already oversupplied with oil, so that would push us down to new lows. So hopefully that kind of I kind of hopefully beat you to it there, Paul, and stuff, in answering your question. So that would be my view at the moment, that if markets tip over into recession, there'll be less demand for oil, in which case in a period where we already have oversupply of oil, and that will have a knock-on impact on that oil. So at the moment, I'm going to see it as a support level, but of course I'll be watching that to see how that plays with regards to other growing crises. and so with regards to the US, let's just finish off with a little bit on some of the the major indexes and what this is telling me, ladies and gentlemen. So this is the weekly chart of the S&P 500 over the last few years, and you haven't heard much about it in the last 6 months, but at the start of 2015, every man and his dog on Bloomberg and CNBC, every fund manager was telling you how they'd had a couple of great years doing nothing more than simply buying the dip in the S&P 500. It was a simple and easy strategy from about 2012 through to the middle of 2015, and you can see yourself there. Every time S&P pulled back, you bought it, and off she went. Pulls back, you buy it, off she goes. Lovely, easy peasy trading. Okay, always easy peasy in hindsight. But going forward now, ladies and gentlemen, now I'm not so sure. And the point I want to make is that when all those people were buying those dips, what happened was price always pushed to interesting thing. Okay, we had a dip, and price pushed to new highs, but that's not happening anymore. And if I just quickly look into this, is the S&P, just looking in, we had the real big drop earlier in the sort of August time. That was to do with China. We had a few wobbles, but price pushed up. But invariably, if you notice, ladies and gentlemen, is that it has not pushed to new highs, and in fact, every high we make is just slightly lower, and that kind of starts to give me a bit of an indication that there's just not the strength, there's just not the enthusiasm, however you wish to describe it. And furthermore, what we're seeing is that we're seeing support in that kind of 1810 to 1835 region. And so what I'm seeing is support at that level, but each high being lower and lower. And so you're starting to see almost like a kind of a reverse descending triangle. Normally, you'd expect a descending triangle at the kind of end of a trend, well, end of a downtrend, not at the end of an uptrend. And so what we're seeing that sort of gives me an indication, with each of these highs being lower, is that a case that that there is some downwards pressure building up on the particular S&P. And the reason I look at that S&P is because, of course, it's every man and his dog looks at that S&P. It's what becomes enormously important in terms of using it as a bellwether for the markets. So clearly Yellen may get sort of a get out of jail free card if we see dollar weakness. And perhaps that might happen to Carney as well, Mark Carney in the Bank of England, in terms of so far we have seen British pound has been crushed. We've seen just continuing malaise in the FTSE, and the thing that hangs over all of this is the Brexit and immediately the referendum. And then even before the referendum, we're seeing David Cameron on his little jet set tours around around the European capitals. He's having some lovely city breaks with Samantha there, but what's he actually coming back with? Well, what he's coming back with is nothing to really there's no real excitable tourist gifts that he's bringing back to us here in the UK in terms of what he's trying to get from his European partners. And so invariably that is having an impact upon the kind of, let's say, the UK led markets. If we look at the FTSE on the weekly, okay, the FTSE, is the FTSE 100 doesn't really reflect the UK economy too much these days because it's heavily weighted towards energy companies and the sort of the big banks, financial services. But and so it's been very, very hard hit over the last 12 to 18 months as we've had a bit of a rout in the commodities, in particular oil. What we saw was a little bit of a push to the high, okay, before the election, but then after that, it's just stepped down ever since, and a little bit like that S&P 500, which we just looked at. If you just drawn it in there on the chart, if you look at there on the weekly highs, each of those weekly highs is just getting lower and lower and lower and lower. And what I also have noticed is that now we're starting to get a lot of weekly closes, okay, below the 6,000 level. So and in terms of actually weekly closes, we've had what 1, 2, 3. We've had about 6 in the last 2 months, okay, in terms of that. And the last time we saw that was back, nearly 4 years ago in 2012. So there's just a few things coming through there, a few little points all coming together that start to get me a little bit worried about, the state of that economy, and the state of the FTSE in particular, and many people are talking about how, in some respects, the FTSE is what has been leading the indexes in terms of its let's say its miserable performance over the last 6 to 9 months. With regards to sterling, okay, and let's have a look at the big one in terms of pound against dollar. Well, what we saw was we saw a high there, okay, and that was in the pre-Scottish referendum, okay, in the summer of 2014, and it hit around about 170, 180, and effectively ever since that we've been in a downtrend ever since. And realistically, because once the Scottish referendum happened, well, then everybody was asking, well, when's the Euro referendum going to come? And that has weighed upon sterling, okay, especially against the dollar ever since. Now, admittedly, we've also seen a good deal of dollar strength in there, so you get you're getting effectively a double whammy. But that kind of the weighing of the Brexit has and some at times kind of worrying economy numbers. We've started to see a real push down in the pound against dollar, and that picked up pace at the start of this year, and what we've done is we've got down to lows of like 141. Now the reason I've picked out that particular level is the last time we had a monthly close down at those lows was January 2002. So we've been getting down to sort of monthly close levels that have not been seen for like nearly 14 years. All right, and that's that kind of well. That would concern you if you're looking to go abroad on your holidays, but that should please you if you've been selling sterling for the last few months, as some of us may have. So it's a question of once again for some people it's a threat, for others it's been a fantastic opportunity. The question has to become, though, who would be a real buyer of sterling down at these levels? That's the question I would ask people. Who would be a buyer down there? Because invariably, with the referendum hanging over us, then the question becomes, well, what are we actually? What are we? Who wants to be a buyer? Markets hate uncertainty, absolutely hate uncertainty, and so what they don't want is to see that hanging around over them. But people want clarity. My own view with regards to Brexit is that I suspect what will happen is that we're the UK is a rather conservative nation. What will happen is that we will probably vote to stay in and then bitch and moan about it for the next 40 years, as we did after the first vote back in the 1970s. But invariably it is such an emotionally charged subject that if you look at the polls, those polls switch constantly, week by week at the moment. one week the in campaign is hugely ahead. Next week the out campaign is hugely ahead. There's a huge amount of emotion written over it, and so it's a question of, until we get clarity on that. I think sterling is always people are gonna struggle with it, and invariably that may help Carney a little bit when it comes to effectively, he's looking to debase currency without him actually having to do anything. In many ways, the Brexit referendum is doing his job for him. This is just a pound against yen on the week, and this you can just see how that's collapsed. Okay, and it's just all it is just another another example of yen strength and sterling weakness. The kind of nice thing about that is we had a little bit of a bounce, but that bounce was capped by the 2015 low. So traders will know that support becomes resistance, resistance becomes support. But realistically, that's just a case of looking at, well, what is the the yen is strengthening, sterling is weakening. How do you use that to help you trade these particular markets? So what we've done is then I've tried to go through there some of the big major opportunities, the big I like to view them as opportunities, and some of the big markets there, and looking at what's showing up. Then I think there's definitely lots of signals there that 2016 could well be a year of crisis for us. So if that happens, what do we do to effectively protect ourselves from the downside risk? And is there anything we could actually do to forewarn ourselves on any upcoming volatility, giving ourselves a little bit of a heads up? Forewarned is forearmed, so they say. Well, one of the things, and this is from the great trader George Soros, is that the secret behind success is to embrace risk, not to avoid it. And that's just the long and the short of it. George puts it much more elegantly and succinctly than I could myself. But the reality is that we're traders, and so as a trader, it's your job to take risk. Okay, and so as a trader, it's your job to manage risk. What I always say is analysts get paid to make a right call, traders get paid to manage risk. And so the better you become at managing risk, the quicker your progression will be to let's say, consistently profitable trading. So how are we going to do that? Well, what could we do? Well, once again, I doff my cap to George Soros when this is my principle is to survive first and make money afterwards. And it doesn't matter whether you're trading a multi-billion-dollar trading account like George, or you're trading your own small private. That should be one of your principles that you look at. Survive first, make money afterwards, and especially in volatile markets. So one of the sort of couple of the rules that I talk to people about is that things you always need to be doing is that you protect yourself from downside risk by following two very simple rules. You always live to fight a new trade markets. And the second rule is you always know where the exits are. Now, how do you actually do that? How do you actually put that into something that you can use from tomorrow? Well, in terms of always looking to live to fight another day, we always use a stop loss for every single trade that we place, and that we only risk a small portion of our trading capital on any given trade. Now, there are lots of different ways that you can set stop losses, and you could go onto the internet and spend the rest of the weekend going through it. But as a general rule, if you're using technical analysis for your decision making, then I would be suggesting that you probably also want to be using technical analysis for where you place your stops. And that in itself could be a whole hour webinar just on where the many different ways you could use stop losses. And generally, as a rule, what I also say is a rule of thumb for most people is that you only want to be risking 1 to 2% of your trading capital on any particular trade. Remember what George said. It's your job is to survive first to make money afterwards. So if you get caught on the wrong side of, let's say, a surprise announcement like Kuroda's last Friday, if you're only risking small portions of your capital, that invariably means that you're in a position to ride out any of the real kind of volatility that you may see come into those markets. And for those of you who haven't read the book Market Wizards, I can heartily recommend it. And particularly in one of the great chapters in there is by a guy called Ed Zigota, and he says the element of good trading: cutting losses, and cutting losses. If you can follow those rules, you'll have a chance. And what I talk about that is the Market Wizards book is well worth reading. You might not learn specific trading strategy, but what you will do is learn what is important to these guys who have been supremely successful traders. And as I say, It's about, those two rules. You always live to fight another day, and you always know where the exits are on your trades. That's what helps you to protect your downside risk in the most simple of ways. So, as I said, we always know where our exits are. And so what we're looking to do is, before we place a trade, we know where we get out when we're wrong, where we get out when we're fortunate enough to be right. And I make a big point of that. Okay, I hear people impulsively just banging the buy or the sell key, and then wondering, having no idea what they're actually going to do with their position. That's not the way. That's not the way a sound professional trader operates. Sound professional trader always knows where the exits are, knows where I'm getting out when I'm wrong, knows where I'm getting out when I'm fortunate enough to be right. Yeah, and the interesting thing is, once you do that, have that plan in place before you trade, well then, to be fair, your trading tends to be a lot less emotionally stressful anyway, because you have a little plan and you let the market do its thing. So what I talk about is one of the quick, simple ways you can do that is a couple of things. You always want to quantify your risk, okay, which is effectively your entry price versus your exit price if you're wrong, and you'll find that professional traders will talk that as units of risk, or we'll call that R. You'll hear me talk about, well, that's R or 2R, etc. You also want to look to quantify your reward, which is a variable, your entry price versus your exit price if you're right. And once you do that, that allows you to start to calculate your risk to reward, your stop loss to take profit, and we start to define that as our risk to reward ratio. And invariably, if you're not doing that already, you should really be looking at what your risk to reward ratios. And invariably, one of the first things you can do is to help yourself is to have what they call an asymmetric risk to reward ratio. So let's say for every £100 you risk, you want to be able to make 200, 300, 400 pounds, and that's the sort of thing that helps put your trading at a different level. So here's a great quote from John Carter, and I thoroughly back this. Amateur traders focus on how much money they can make on each trade. Professional traders focus on limiting risk and protecting capital. So professionals always take money away from amateurs. What I mean by that in this particular case is that even though I see that there's going to be a lot of crisis happening, there'll be a lot of market moves, there'll be a lot of volatility, which I think that is a huge opportunity for us as traders. That doesn't mean that my risk principles go out the window. If anything, they become even stricter. They become even stricter because that's what you have to do to operate like a professional in the market. So finally, we talked about what we can do to look at limiting our downside risk. But what can we do in terms of be forewarned on upcoming volatility? Is there anything that we could do? Well, what I'm going to do is talk about is a very simple tool that you'll find on the Valutrades MetaTrader 4, and it's called the average true range as the ATR. So there's a little clip there, put in a little photo shot there. You can find that on your MT4 platform. If you've not, if you're new to using MT4, it's just under the indicators and then down onto the oscillators, and you'll see that average true range will show up there. Okay, and that's something you can choose. And as a general rule of thumb, you kind of use a 14 period setting. That's a kind of a pretty much accepted one. Now, for those of you who love to dig into the details around about their average true range, well, there's plenty of information you can find there on across the internet. But it's just a technical analysis volatility indicator developed by a guy called Jesse Wells Wilder, who actually developed an awful lot of technical analysis indicators. Doesn't provide indication of trend, just the degree of volatility, and that's what we're looking for, right? And what we use it for is that true range shows the commitment or the enthusiasm of traders. So when an increasing range indicates price continues to be bid up, so there's clearly a lot of people interested in that. On the flip side, when we see the range decrease, that suggests waning interest in that particular instrument. So let's have a look at as a good example. Here's the euro dollar on the weekly chart. So what we had was we had a huge moves down there. You can see that we all know what happened, and then as Draghi starts to confirm that eurozone QE will happen, what we see is that the actual ATR starts to turn up. Okay, and that increase in that is indicating that there's increased volatility, enthusiasm, endeavor, trading within that particular instrument. And as you can see, that basically went all the way up for the next 6 months. And so that's giving us an indication that there will be, increasing volatility in that particular instrument. And that can start to have an impact on where we do things like placing stops and where we place our targets. Okay, and that's a little point for us to discuss. So what it does is, I say, it gives savvy traders an indication that volatility is decreasing in an instrument. And then what you can do is you can use that to determine where you place your stops and also actually your targets. And that's what you're doing if you remember those rules 1 and 2, to live to fight another day and to always know where your exits are. Okay, when you get into a trade, you can start to use that ATR data to help influence those particular decisions, and you're making solid evidence-based calls. So here's a little extra piece for you, for those of you who've stuck with us. Just a little extra piece is that look what happens when we also add 100 period ATR to that indicator. So see how we get a much stronger signal here on the same euro dollar weekly chart. So that what we saw is that the beforehand we saw that the short term ATR was below and heading down a much the longer term, the dark green ATR. But invariably, when it crossed and turned, that was a great indication that invariably we were starting to see real increased volatility within that instrument. And on the flip side, during last summer when it crossed below it, then invariably that was an indication that we were just going back into a bit of a range there, and that's strangely enough that's exactly what we've had for the last for the euro dollar. So just have a little look at that and see if that's something that you could use to help yourself in your own trading. Maybe take a little look, have a little play with that, and see if that's something that could help you, give you a little bit of forewarning of when perhaps a possible increase in volatility is going to happen. I thought I'd add in just a very simple one from very recent. So here we go back to dollar yen, and look what happens when we see a cross of the 14 above the 100 ATR, indicating an increasing volatility. And that happened about a week before we saw the surprise announcement by Kuroda. We had a nice pin bar, a kind of level price tipped up before it shot, kind of a little indicator that that actually something was happening. There was an increase in the in the volatility and the enthusiasm for dollar yen. So once again, it's a question of take away and have a little look at that, and have a look at, is that something that you could use to help you in your own trading. So just a little sort of a cheeky gift for you there. So in conclusion, ladies and gentlemen, 2015 was a volatile year, and we've seen so far that 2016 has the chance to be even more. Already 4 or 5 weeks in, we've had all manner of things going on. So what we'll see is, we're going to see that euro and yen strength, and that may hurt their economies, but then that might also help, US dollar and also sterling as they weaken. That's what perhaps Carney and Yellen would like to see. So if there's going to be lots of opportunity out there, but during those times of crisis and volatility, we always remember 2 simple rules. 1, we always need to live to fight another day, and secondly, we always need to know where the exits are. And so by doing that, by making sure that we never trade without a stop loss, and that we only ever risk a small portion of our trading capital, that keeps us in place. But what also we can use is the ATR, the average true range, can help us judge volatility. And that might actually give us a little bit of forewarning that something's about to kick off in the particular instrument or market that you're trading. And as I said right at the very, very first slide, with all of this happening, the question for yourselves, ladies and gentlemen, as traders, is do you see that as a threat or as a particular opportunity for you? So there you go, ladies and gentlemen. That I hope you found that interesting. I hope that gave a little bit of insight into the major markets and a little bit of a reminder of how to manage risk. And as I said, have a little look at the average true range, maybe even using a double or maybe even a triple one, to see how you could use that to help give you a little bit of forewarning of that volatility, so that you're prepared for what might be coming down the garden path. So I hope you found that useful. I hope you found that enjoyable. Sorry for my rasping throat, but if you've got any further questions, I'll happily take them. Or alternatively, the Valutrades people will be happy to answer any particular questions that you actually have. You're very welcome, Paul. Hopefully that's given you something to have a little play with over the weekend. Have a little look at how that could help you. And you're absolutely right, Dan. Thank you. It should be a very interesting year. I think it's going to be a very interesting year for us. Certainly, Dan, you can use volatility index as a risk measure. Part of that is effectively that links to particularly to shares. What the ATR I use is it really doesn't really particularly matter about the instrument. And if you really want to get into the depths of the VIX, then I can heartily recommend having a look at something called the VVIX, which is the volatility of the VIX. You probably have to have a Bloomberg terminal to be able to view that. But VIX is fine and it is useful, but my own view is it tends to be more useful for kind of the shares and the indices markets rather than something that can be, let's say, kind of like multi-asset or is sort of asset agnostic, so to speak. Yeah, take a look at it, Dan. ATR, it's on there. It's on the MetaTrader 4 tool. It's it's a very simple tool. You can you can have it a little. There's plenty on the internet to if you want to read further detail about it. Very very simple and just I said you can use it to give you an indication of volatility, and also use it to have a little look about sometimes where to place stop losses, etc. Naren says big head and shoulders forming on the SPX, so more downtrend to come, I think. Yeah, I wouldn't fight you on that view, Naren. I think that I think it is falling out, and I think the closes we saw this week and such, none of them really filled us with any kind of confidence. The numbers were fine, NFB numbers were fine. They were fine. The wage was fine. We're seeing the employment rate got below 5%. So they're in a good place. They're actually not a bad place. But the question is that the Fed had talked about doing 4 interest rate rises this year, and but the thing is, I don't think anybody in the market thinks that's going to happen. So there might be one at best. So that's one of the reasons for people's let's say lack of enthusiasm for dollar and markets at the moment. Yeah, that's absolutely right. If you've got any further questions regarding ATR indicators or the Valutrades at MT4 platform in total, and then by all means give the support team a support@valutrades.com a shout, and they'll be very happy to help you and talk you through any of the questions or challenges you may have using that. Same to you, Dan. Take care out there and trade well. You're very welcome, John. Nice to see you there. Enjoy the rest of your weekend. You're very welcome, Paul Malta. Enjoy your day. You're welcome, Eric.